let's continue with our discussion around life cover. So as we all know, your life cover increases every year, or your premium for your life cover increases every year. So what people don't understand is that those premium increases are made up of different types of increases. The first part of those premium increases are what we call compulsory premium increases. So a compulsory premium increase is a way that the insurance company increases the premium because of your increased risk as you get older. So your premium will increase for the same amount of cover. So let's say you have R1 million worth of life cover, you're paying 500 Rand a month. Next year, because you are older, if you have a compulsory increase, you will say pay, for example, 550 Rand, but still for the R1 million life cover, because the risk increases as you get older. So that's the compulsory increase portion. Then we have the voluntary increase portion. Now the voluntary increase portion is a percentage of your increase that is used to buy extra life cover for you, so that your life cover or any other cover that you have can keep track with inflation over time. So remember, R1 million this year is not the same as R1 million next year, because inflation has eroded the value of your money. Now, if you look at the compulsory portion increases, there's different levels of increases there. The first one, which is the most well known or used one, the most often used increase, is the age-rated increases. Most of your insurance companies these days work on these age-rated increases, which means your increase is related to your age. So if you are in your 20s, you might only get an annual increase of, say, 2 to 3%. If you are in your 30s, it might be 4 to 5%. If you're in your 40s, it might be 7 to 10%, and so on and so forth. So as you get older, your increases become higher as you go, as you get older. So that is age-rated increases. Then we have fixed compulsory increases. So this is where you decide what you want your increase to be, no matter what your age is. So let's say, for example, you want a 5% fixed compulsory increase. What then happens is, doesn't matter how old you are, every year your premium will increase by 5% to keep your cover exactly the same. The next one is what we call a level premium. Now, a level premium is the insurance company works out what your premium is now, and you will keep paying that premium for the life of the policy. So if you have a level premium of 700 Rand for 1 million, doesn't matter how old you are, that 700 will still buy the 1 million Rands worth of cover for you. So that's the level premium. And then we have one that we call stepped increases. So what will happen with a stepped increase is you will have a fixed premium for a period of time, say 3 or 5 years, and then it will jump by, say, 20 or 25%, and then it will be fixed at that rate for 3 to 5 years. And after that, it will jump again. So it will increase with steps as you go along. Now, if we look at those different options, the higher the increases are initially, the lower your initial premium will be. So let's say, for example, you have a 10% compulsory increase. You might get your 1 million life cover at 400 Rand per month. But because it's got a 10% increase, over time it will become more expensive than what you have if you have a level premium, where you might start with 700, because the 400 will increase every year, and eventually it will meet up with the 700, and then it will increase past the 700 rate. So a lot of people look at that and say, but isn't it then better to have level cover or level premium, even if I pay more? Again, our opinion is that age-rated is one of the best ways of doing it, because what you must remember is, as you go through your life, your need for risk should be reducing over time. So you want the best possible cover for what you need for the lowest possible premium now, and then you adjust that as you go along. And as your need for risk reduces, you can then reduce your risk over time to counteract those increases in premiums. But what you guys must also remember, and this is where it's very important to understand, when advisors, brokers come and they start focusing solely on trying to beat the premium that you've got. The focus then becomes on getting cheaper cover or getting more cover for what you're paying, and then they start manipulating the premiums. So you might have a level premium and they will give you a compulsory premium increase so that they can give you a lower premium per month. Always ask so that they can explain what the implications of that is. So make sure that it's not purely a situation where the numbers, the cover amounts look like it's the same or better, but they've manipulated things like premium increases. They've manipulated things like your underwriting criteria. They've manipulated. They've given you accelerated benefits instead of standalone benefits. So there's all these things that you need to look at before you can really determine whether product 1 is better than product 2. And that's why when we work with clients, we don't focus on beating a product. We focus on what the client needs and then building something that does that. If the needs stipulate that there's a need for accelerated benefits, then that part we will use accelerated benefits for. But if the need is standalone benefits, we will use standalone benefits. So guys, always make sure that when you work with an advisor, that advisor works towards your goals, towards your needs, and not just focus on how can they beat what you've currently got. Okay, so then we have the voluntary increase. Now, the voluntary increase portion is how much more cover you buy every month or every year to increase your cover. So you can then, there's 2 basic ways that you can increase your voluntary cover. The first one is to link it to CPI or inflation. So your increase will increase with inflation every year. The problem I have with CPI increases is you never know, so you can't really plan. So you never know exactly what that increase will be. So it can be 4%, it can be 6%, it can be 9%. So I like the fixed voluntary increase better than I do a CPI increase, but that's just a personal preference that I have because I like to be able to plan what's going to happen in the future. So a fixed increase, you say I want to buy or take 3% extra premium to buy more cover. The benefit to that is it automatically qualifies you for future cover without you having to qualify through medical underwriting. So it pre-qualifies you for more cover in the future. So if something happens and you become uninsurable, your increases will automatically still be able to buy more cover, although you might have trouble taking out new life cover with another company because you've had a heart attack, etc., etc. So with those increases, what you must understand is if, let's say you've got $1 million life cover, you've got a 10% voluntary increase. So that means you're going to buy with 10% more premium, you're going to buy 10% or you're going to buy more cover for the year. That doesn't mean your cover will increase by 10% because your premium increased by 10%. Because it doesn't buy that cover at the same rate you bought cover the previous year. So for example, if you have 500 Rand buying $1 million life cover, you increase it by 10%, you now have 550. But that 50 Rand won't necessarily buy you another 100,000 Rand because your rates have increased because you're a year older, which means the risk is a little bit higher. So that 50 Rand might only buy you 90,000 Rands worth of cover. So don't expect when your voluntary increase is 5% that your cover will increase by 5% because it's not directly related to one another.